Good morning and welcome to all attendees to this webinar today on renewable energy certificates and grid emission factors in corporate and national emissions accounting. My name is Chris Yelland and I'm the Managing Director at EE Business Intelligence, and I'll be your host at this webinar, signed in from Johannesburg. Welcome also to our presenters, who will be introduced to you in due course. I will share a link with you now on the Zoom chat facility where you can download the presenter biographies. So take a look at the chat box and you can download this document. And welcome to you, the attendees, for your interest and participation today. This webinar is hosted by EE Business Intelligence. But I'd like to acknowledge and thank the DFFE, that's the Department of Forestry, Fisheries and Environment, Meridian Economics, Hulamin, Globalec, and the Victoria Energy Policy Centre, the University of Victoria in Australia, as well as MAC Consulting, for their valued support in this webinar and for the really great work that they do in this field. Just over 1,500 delegates have registered to attend this webinar to hear what the presenters have to say on the subject. This attests to the relevance of the subject matter under consideration, as well as the stature of the presenters. So may I thank the presenters up front now for their participation and for the time and effort they have put into preparing their presentations. Please do note that this webinar is being recorded, and links to view the webinar on demand and to download all the presentations will be made available tomorrow morning at about 9 o'clock to all those who registered to attend, as well as publicly. We'll be sending a feedback report by email in this regard. Colleagues, South Africa's electricity supply industry is undergoing profound restructuring as unbundling and liberalisation takes hold. Alongside these structural reforms, a critical technical and policy issue is emerging, namely how to identify and track the clean energy attributes of electricity as distinct from the underlying electrons in a robust and credible manner that supports both voluntary and compliance-based electricity emissions reporting. The Department of Forestry, Fisheries and Environment has published a methodology for calculating South Africa's grid emission factor. But this 2021 framework did not anticipate the new market reality where IPPs, traders, and Eskom Green may sell electrons and renewable energy certificates separately. Without a system for creation, transfer, and retirement of regional energy certificates, South Africa risks distorted carbon accounting, regulatory gaps, and reputational risks for both government and corporates. So this webinar will firstly explore the implications of renewable energy certificate trading and market reform for grid emission factor calculations. Robust emissions reporting will be covered, and rigorous corporate Scope 2 accounting under the Greenhouse Gas Protocol will be covered. Secondly, this webinar will assess international best practice in renewable energy certificate tracking and emissions factor methodologies. The webinar will also consider the institutional and systems architectures required to govern renewable energy certificate issuance, verification, and tracking. And lastly, the webinar will discuss the calculation of the national grid emission factor, especially as Eskom Green, IPPs, and imports alter the carbon intensity of the grid mix. And lastly, the webinar will highlight risks for companies on their assumptions about reducing grid emissions factor and accompanying decarbonization. So we've got 7 expert speakers today who will draw on analysis from the DFFE, from the National Business Initiative, from Meridian Economics, the CSR, and the UCT Energy Research Group, and various industry stakeholders in order to unpack these emerging challenges and chart a way forward. So the program for today has been widely circulated, but I'm going to now share with you a link where you can again download the program for today. So keep your eye on the chat facility now to get the link to download the program. As I said, we've got 7 expert presenters today who will each give 15-minute presentations. And in between, we're going to have a 10-minute comfort break. After this, we've set aside about 30 minutes for our presenters to answer just some of your questions in an open Q&A discussion. While the presentations are in progress, please do send your questions on the Zoom Q&A text facility, not on the chat facility. On the Q&A text facility is where your questions must be. You may also put up your hands to ask questions verbally during the Q&A session. So without further ado, I now want to introduce our first presenter. And as I'm doing so, please can our first presenter put his share his presentation. But let me introduce Yongi Witi from the Department of Forestry, Fisheries and Environment. Yongi is the Chief Director of Climate Change Mitigation and Specialized Monitoring Services within the DFFE's Climate Change branch. His work focuses on the determination of greenhouse gas limits to industry, the allocation of sectoral emission targets to sector departments, carbon tax MRV system, and outlining the development and emissions pathways towards net zero by 2050. He's a member of the United Nations expert panel responsible for reviewing national climate change submissions, and he serves as a coordinating lead author participating in the development of new IPCC methodology guidelines on quantifying short-lived climate forces. And Yongi holds 2 master's degrees, one in atmospheric science and one in energy studies. So it's a great honor and pleasure to have Yongi to give us the opening presentation. And I'd like to now hand over to Yongi. Over to you, Yongi.
Thank you, Chris. Good day, everyone. I hope you can see the presentation. Can you confirm, Chris, if that's the case?
100%.
Thank you. Yeah, so yeah, thanks once again. I think from the DFFE side, our interest in this webinar is just to reflect the implications of how we treat electrons and associated environmental attributes, whether they are bundled or unbundled, and the implication to the grid emission factor determination. As Chris pointed out, in 2021, we developed a methodology for the determination of the grid emission factor. We were thinking in terms of anticipating, the policy reform specifically from a climate change perspective, but not necessarily from an electricity perspective. So we were thinking, for example, that with the coming Climate Change Act, there will be climate change response measures that will put in place. And some of them will have emission reduction implications that, for example, relate to Scope 2 emissions. And therefore, we need to put in place this measure so that there's certainty to all the stakeholders, especially those that will be subject to the policy instruments that we are developing. So the motivation really was to inform policy making. For example, as some of you might know, currently, we have published regulations for determination of carbon budgets. Those are limits that are allocated to industry and linked to that mitigation plans that supports the implementation of those carbon budgets. In that scheme, Scope 2 emissions can be elected to form part and parcel of the carbon budget allocation. So obviously, the grid emission factor plays an important role in that. But generally also just to enhance the accuracy and integrity of emissions related to electricity usage. So that was also our intention. But also to support market-based mitigation instruments, for example, involving carbon credits as well, so that we provide certainty there as well. As you might know, Minister last week announced on the Article 6 framework that the country will adopt. So in terms of that process, we had a larger stakeholder engagement. And here I must also acknowledge IBIS Consulting, who supported us in the development of this methodology. We looked at other reporting regimes and countries globally to see how they are developing these grid emission factors and what informs them. And post that, with these emerging issues that Chris raised, we felt strongly that we need to start looking at the impact of these electrons and the associated attributes. And here I must also acknowledge Dave, who will speak later, who was really persistent in trying to organize all of us to start looking at this issue. And as such, we formed a task team led by DFFE, including the constituencies that are included there, but there's others as well that form part and parcel of that. In terms of the grid emission factor method that we use, we have about 4 grid emission factors, but here I'm just reflecting the two important ones. The first one is the domestic generation grid emission factor, which accounts for emissions emitted per unit of electricity within the South African borders. So that is the one factor that we use. A lot of people have asked the question, what is the value of this factor from a policy point of view? And our response is that we view that as an indicator just to measure the extent to which the grid as a whole is decarbonizing. So we just use it as an indicator, as part of our climate change indicator. Then we've got the National Generation Grid Emission Factor, which depicts the relationship of emissions and end-user electricity consumption. This is the most widely used grid emission factor for corporate reporting, but also for policy making in terms of some of the instruments that we've developed. We do report also on transmission and distribution factors, looking at the losses, but that's mostly relevant for Scope 3 emissions as such. And I'm sure most people have seen the reports that we published. There's one that we published in 2025, July, that was dealing with the 2023 year, basically. So the method is quite simple. From an emissions point of view, the one advantage that we have as South Africa is we've got a very comprehensive emissions reporting program where entities report on an annual basis their emissions. So we have fairly sound, good data, including, for example, Eskom, who's the major electricity generator in the country. And the one additional aspect about that is for some of the sectors, we have instituted the use of higher tier methods for quantifying emissions. So in some cases, entities use tier 2, and in some cases, tier 3, which means we reduce the uncertainty associated with those emission estimates. And then for imports, largely, we have the Southern Africa Power Pool, where we make use of the grid emission factor from that. So we have sound information when it comes to emission. And then in terms of electricity information, our two key sources is NERSA, in terms of electricity generation, auxiliary consumption, own use, and sales to the grid. And then we also have Eskom, who helps us with transmission losses, distribution losses, imports and exports. So we have also fairly good information. So if you're a generator and you're not captured by any of those, chances are that we are missing you in our accounting of the GEF. So that method is understood, and we've published several reports, and this actually shows results for the 2023 year. And what I've shaded there in sort of limeish color is the results of these grid emission factors. Our anticipation was that we wanted to support a wide range of use cases. So depending on your circumstances and where you are in terms of the electricity value chain, you can apply, and also the purpose, you can apply the grid emission factor that you deem appropriate in your case. But as Chris indicated, we have realized that we need to, respond to the impact of changing electricity market on the GEF methodology. Because if we continue in the manner that we are doing now, probably in 3-4 years' time, this grid emission factor that we publish will be meaningless. And there's a couple of policy considerations that must be taken into account. One is the accurate accounting of the GEF. So here, we're just making an example that, if an IPP sells electrons to Eskom, but might sell the environmental attributes to someone else, it means where the data that we receive from Eskom in quantifying the GEF has to take that into account. Otherwise, we will not be accurately accounting for the GEF. So there's other implications also in terms of tracking. The second point also is that a lot of the companies are developing their decarbonization plans, largely to respond to their net zero objectives, but also to respond to the upcoming legislation requirements in terms of mitigation plans and carbon budgets. And obviously, for Scope 2 related interventions in those decarbonization plan, it's important for them to apply a GEF. And therefore, in that case, it's the GEF that has to be used, has to take into account this issue of an evolving market. And therefore, we see that we will need to have some form of a residual national grid emission factor instead of the ones that we are quantifying now. And then for more from a policy point of view, we have what we call, greenhouse gas mitigation plans that are mandated, that key emitters, especially those emitters that currently emit more than 100,000 tons, will have to develop. But this has been reduced to 30,000 tons now. So if you are an industry player and you emit more than 30,000 tons, you'll have to be allocated a carbon budget, and with that, a greenhouse gas mitigation plan. So if your mitigation plan has got scope 2 interventions, obviously you'll have to apply a grid emission factor to translate that into the emission savings that will be accrued from those measures. Obviously, if we use the normal grid emission factor without accounting for these environmental attributes that could be sold elsewhere, then we will not be able to track that and claim accurate mitigation efforts in that case. What this also means for DFFE is it's not clear for us then in that case how we will track this or verify it, because we will just be receiving on an aggregate level, electricity and emissions. So there is a tracking issue here that we have to deal with, and that links to my last 2 bullet points around resolution. So currently the grid emission factor that we publish is based on annual aggregate figures of emissions and electricity generation, which is not ideal for market-based reporting, because that requires consumers to use supplier factors from each entity that they have contractual supply relationships with. This will include a wide range of stakeholders. Eskom will probably still largely be the large supplier, but there will be municipalities, individual, IPPs, and so on. So the question is, so it becomes clear to us as DFFE that in terms of a sound and robust tracking system, we are not in a position to offer that, because a lot of the information and mandates involved in doing this goes beyond our own mandate. So it means we have to work with other role players to develop and design this system to address this, both what people call location-based reporting and market-based reporting, so that we have a comprehensive system to deal with a wide range of use cases. So in terms of a way forward to deal with this, so we have set as a task team to really map a way forward, and instead of just jumping to solve the problem, we thought we should actually start thinking about what is the nature of the problem we're trying to solve. And that is what we are capturing in this phase 1, which is a scoping exercise. Here we like to recognize and thank Meridian Economics for agreeing to do this pro bono, to unpack for us what is this issue that we are dealing with and what are the implications. So this exercise is considering international experience, because obviously we are not starting from scratch. We need to understand what others have done in terms of this. From a number of of perspectives: development of the GEF, number 2, the tracking mechanism of all these electrons and attributes, the monitoring, reporting, and verification system for it, and also the policy and use cases that are considered. So that is the scope 1, which is led by Meridian. I think the next presentation will deal with that. And then once that is done, we will move to phase 2, which is concerned with scoping implementation. Here, there's a couple of issues. We'll obviously build on phase 1, examine reporting standards that are required to maintain, especially reporting and methodological soundness to deal with, for example, compilation of a residual grid emission factor. Also, there's an interest in examining trade implications, especially CBAM. For example, they are using, as we speak, a generic grid emission factor. So there were going to be engagements to make sure that they use the national grid emission factor, but obviously that needs to be reviewed. And this will also mean we will start working on reviewing the GEF methodology, as we indicated. So that's phase 2. And then phase 3, we have to think about institutional arrangements. As I mentioned, the monitoring, reporting, and verification scheme for this will be complex. It needs a registry. So we need to first identify the entities that can help us to deal with this issue in terms of both location and market-based reporting, because both of those will still be relevant all the time. I've mentioned the issue and the need for a registry. And then we'll have to assess the need to develop legislation when necessary, especially, for example, mandates for reporting and tracking of these environmental attributes. So if you unbundle and bundle, we need to know, such information and report it in a detailed format. So all in all, that is what we're aiming to do in terms of this project over time. So that was my last slide. Chris, over to you. Thank you.
Well, thank you very much, Yongi, for that very clear and articulate presentation, which really sets the scene for the further presentations today. It's been an honor to have you, and I want to thank you and the department for the work and your participation. So we're now going to move on to our next set of presenters, and these are Emily Tyler and Brett Cohen from Meridian Economics. Now, they have done a lot of work and a major study on the subject that we're talking about today. And I'm going to ask my producer, Ian, to share now a link to the work that they have done on the chat facility, so that everybody is in a position to download this work by Meridian Economics. So Ian, if you can do that, and in the meantime, I'm going to introduce you to Emily Tyler and Brett Cohen, who will be doing the next presentation jointly. Emily leads the climate practice at Meridian Economics. She is an expert in energy and climate policy and strategy in developmental context, and she brings a lens of complexity and systems thinking together with her disciplinary grounding in economics, finance, and political economy. Her professional experience has spanned carbon pricing and budgeting, climate finance, power sector modeling, policy instruments, corporate and investor carbon strategies, and the international climate policy regime and low carbon transition planning. Finding the interplay between practice and reflection particularly rich, Emily holds an honorary research associate position at the University of Cape Town's African Climate and Development Institute, and she is an IPCC scientist. And moving on now to Dr. Brett Cohen. Brett is an associate at Meridian Economics and an honorary professor in the Department of Chemical Engineering at the University of Cape Town. His consulting work centers on climate risks and opportunities, greenhouse gas emissions, counting and projections, energy and climate change scenarios and future planning, as well as mitigation technology evaluation. Through this work, he contributes to evidence-based climate and energy policy development and strategic planning in the face of complexity and uncertainty. Brett holds undergraduate and PhD degrees in chemical engineering from the UCT, and he is a contributing author to the Intergovernmental Panel on Climate Change's 6th and forthcoming 7th assessment report. So we've got two really well-experienced presenters here. They're going to do this presentation jointly. Firstly, Brett is going to start with the presentation. He will then hand over to Emily and then back to Brett to close out on the presentation. So with that, over to you, Brett. We're looking forward to hearing your presentation.
Great. Thank you very much, Chris, and good morning to everybody. So as Chris has indicated, I'm going to be talking to you about the study that we conducted, looking at this broad issue of grid emission factors and environmental attributes. The study was, contrary to what Jongi said, was not pro bono, but it was an independent public benefit funded project. But we did do it in consultation with the DFFE technical committee or steering group. So we had a lot of input from them, but it is a standalone study. And the purposes of the study were firstly to explore the implications of the changing South African landscape for electricity sector emissions, as Jongi has already alluded to. to consider deeply within this how the trade in environmental attributes is to be treated in emissions calculations for the energy sector, to explore a little bit more the kinds of electricity emissions factors that are required for different applications and for different users. And then finally, and quite critically in terms of moving ahead with improving accounting for environmental attributes in electricity emission factors, to describe the systems and the roles and responsibilities that are required not only for measurement, verification, and reporting of environmental attributes, but also for the grid emission factor calculations, recognizing that DFFE has been doing a lot of this work to date. So as Chris has already indicated, our report is hot off the press on the Meridian website, so we'd encourage you to download it and use it. So first of all, we would just have a brief look, and this is somewhat repeating what Jongi has already said about what are the uses of electricity emission factors and who are the users going to be by who are the users going to be. So the first key area that's critical is around policy making and tracking of policy implementation. And this is both at the national level, but also considering that provinces and cities are taking climate action as well. So examples of these applications are the establishment and tracking of decarbonization policies for the electricity sector. So grid decarbonization, as Jongi has already alluded to. And then also it's a critical requirement in order to assess emissions reductions from any electricity efficiency projects. And there are a number of other examples in the policy-making sphere. There's then the compliance with mandatory reporting and targets. At the moment, this is largely focused on the international space. So an example here is the forthcoming carbon border adjustment mechanism for the EU, with other regions proposing similar mechanisms. But there's also a potential that in future there could be domestic renewable targets introduced at the national, regional, or local level, which has been seen in other jurisdictions. And we've certainly heard talk of this in certain cities in South Africa. And then finally, there's the point about voluntary entity level reporting, which Jongi alluded to, which is in response to the need from private sector companies and governments, again, subnational governments, who are under pressure to track and mitigate and report greenhouse gas emissions. And as in addition to this, there are a number of entities that are signing up to voluntary targets and reporting frameworks, like the RE100 or REN21. So there are sort of three key areas where we see a need for electricity emissions factors to be accurately and transparently calculated and reported. So in order to ensure accuracy of the emission factors, it's critical that we account for these environmental attribute markets. So we need to, first of all, understand the emissions associated with each unit of electricity. But then on the other side, we also need to understand what claims are made to the greenness by individual parties and how this will impact on the claims around a unit of electricity's emissions. And this greenness is what's given the term environmental attributes or an environmental attribute. Before I carry on, I think it's quite important to note that there is a fair amount of variance in the literature in how a number of the terms that I'm going to be using in my presentation are used. So we've come to a standard set of terms that we're using, but you may wish to debate this or question how these are used and find different terms used in the literature. But the way we are defining an environmental attribute for the purposes of this report and the presentation is as a contractual instrument that represents the proof of renewable electricity generation or the environmental attributes of electricity that are used to track, substantiate, and trade claims of renewable energy consumption or emission reductions. And that distinction is quite important, and I'm going to come back to it in a later slide. There's the renewable energy consumption side of things, and there's the emissions reduction side of things. And once again, these environmental attributes are used for compliance with either mandatory or voluntary energy attribute policy schemes and targets. So we've developed a bit of a typology of environmental attributes for the electricity sector that frames the remainder of our work. And we distinguish here between what we call energy attribute certificates, with acronym EACs, and carbon offsets. So an energy attribute certificate is a certificate or an instrument that represents, say, 1 MWh of electricity that is generated from a particular energy source. So that is commonly used to refer to renewable energy certificates. So in other words, 1 MWh of electricity generated via wind or solar, for example. But there is also the possibility to specify these energy attribute certificates in terms of a fossil carrier. So you might be able to generate a gas renewable energy certificate, a gas EAC, for example. But the focus of the remainder of this presentation is largely on the RECs, even though the two may be used interchangeably. And then on the other side, we can specify an electricity environmental attributes in terms of the carbon emission reductions that has been achieved by adopting a particular energy carrier. So it might say that a carbon offset might say that there has been a savings of 1 ton of CO2 equivalents for each megawatt hour of renewable energy that has been generated, for example. Our focus in this work is on energy attribute certificates. The carbon offset space is relatively well defined. We have some systems in place to manage carbon offsets, and so we won't be focusing on this side of the diagram, on the right-hand side of the diagram in the rest of the presentation. But just one important point to note is that it is critical that one does not double count carbon offsets and energy attribute certificates. So if a claim is to be made around, for example, a megawatt hour of electricity, one cannot issue an energy attribute certificate and at the same time also claim that an emissions reduction has been made in terms of carbon. This would be double counting the environmental benefits associated with that particular megawatt hour of electricity. Now, there are sort of standard ways in which these electricity attribute certificates, which again is going to be the focus of our presentation, are managed. And it's quite critical to start thinking about some of the systems that need to be put into place for management of these in a transparent and consistent way. So when a megawatt hour of electricity is generated by a generator, they then apply for an issuance of an electricity attribute certificate or an energy attribute certificate. These certificates that can then be traded between a renewable generator and a user. So it's possible to sell that characteristic of that megawatt hour of electricity to somebody else who might want to use it. And that user of that EAC can make a claim to the green benefits or the environmental benefits of that EAC for the purposes of reporting. So the three high-level stages in this EAC life cycle are issuance of the certificate, transfers and trading, and retirement. And in order to do this in a consistent and transparent way, tracking systems are required. And these tracking systems are realized through something called a registry, and registries are defined in terms of standards and standard operating procedures that govern this whole process that you can see on my screen. So I'm now going to hand over to Emily, who's going to talk you through some of the implications of EACs for electricity emission factors.
Thank you very much, Brett, and good morning, everybody. We're now going to turn to the emission factor side of the story. And in order to navigate through this, I'm going to be using a stylized diagram of the South African electricity sector as it changes over time. This is we have found quite a complex analysis, and so it's all the information is in the report that you will need, but hopefully you'll be able to to follow these slides using the stylized diagram. Oh, there we go. Okay, so starting off, here we have the depiction of the electricity sector. On the left-hand side, we have representation of generators, renewable, fossil fuels. We acknowledge there's nuclear and gas in there as well. And then at the bottom, there's a representation of an import from the SAP. Within the sector, there is Eskom currently, and Eskom distribution and municipalities who then distribute the power. And then on the right-hand side are companies and residents who use the power. And at the moment, there's not a lot of focus on environmental attributes relatively. So we haven't depicted that in this diagram. We assume that the environmental attributes come with the electrons depicted in gray arrows for the flow of them going from the generators through to the consumers. There are no compliance targets yet in South Africa around energy attribute certificates. So Jongi has covered that the DFFE has started publishing the grid emissions factor, which in this diagram comprises the emissions associated with generation on the grid, which includes the imports from SAP in the national generation grid emissions factor for reporting purposes, and then the domestic generation grid emissions factor, which doesn't include the SAP imports, and this is primarily for policy-making purposes. Largely, customers have up until now been able to assume the national grid emissions factor for reporting purposes because they have one supplier and limited contracting of environmental attributes. The transmission loss and distribution loss factors we're not going to consider further in this depiction, just so we can get the main components of this across. So going further, as we've understood from the last two speakers, we now have environmental attribute markets, and it's also we have the power sector reform process that make this more complicated. So I'm going to pick up from the third bullet point, which the implications of this is that additional electricity emissions factors are required for what's called market-based reporting. And we base our analysis from the Greenhouse Gas Protocol seen on the right-hand side, which is quite a dated document at the moment, yet it remains the industry standard for greenhouse gas reporting, both for direct emissions and for these scope 2 electricity emissions associated with the generation of acquired and consumed electricity. So if we go back then to our market or our electricity sector diagram, and there've been some changes because there in essence two markets have been added here. The first is a market of electrons, which is represented by the SAWEM, the South African Wholesale Electricity Market, and then the addition of green retailers at the moment. There will be other retailers and traders. We still have Eskom distribution and municipalities distributing electricity. All of these are now suppliers of electricity in this market. You also have direct suppliers represented at the top, where you have a contract between a generator and a company directly wheeled across the grid. So the market includes these direct contracts, it includes wholesalers, it includes retailers, it includes suppliers such as Eskom distribution and the municipalities. And these arrow flows are still showing the electrons. So we have the electron market that is developing. We also then have the market for energy attribute certificates developing. And these energy attribute certificates can come with the power or without the power. So the depiction of the dotted arrow at the top shows that the electrons and the EACs are sold together, but then immediately below that, some electrons and some EACs are being sold separately, and you'll see right at the bottom that the SAP power has sold electrons, these are hypothetical examples, but have sold electrons, EACs separately to the electrons it sells onto the grid. One could think of the Korobasa situation here. This means that we then have different supplier factors. So the electricity that is sold from SAWEM to the retailers, or even to large customers, comes at a supplier factor, depending on the mix that that particular supplier, the generation mix that they have of EACs and emission factors. So the suppliers, sometimes when there are retailers in the middle, like the green retailer at the top right-hand side, will then source additional EACs separately or EACs with power. But the point being that each supplier can have a different emissions factor at which it sells its electricity. So this obviously introduces the potential for competition between retailers for being able to supply green electricity to customers. And customers obviously have a choice as to where they get their electricity from. And we anticipate that the greenness of the electricity, or the emissions factor, is going to play an increasing role in that decision-making going forward. So these are then introduce a set of market-based supplier emissions factors against which companies will need to report. You still have your national grid generation emissions factor as being important for reporting purposes, because the greenhouse gas protocol, especially in markets where there is not full coverage of energy attribute certificates and contracts, the location-based reporting, what is called location-based reporting, is essentially the national grid generation emissions factor that is used to cover the gaps. I think one thing that's really important to note from this slide is that the SAWEM is a supplier in this market. It is not the whole market. That's certainly from an emissions perspective, I think that's important to note. So then going one level deeper on this is, how do these suppliers consider the construction of their supplier emissions factors? And this depends on how the emissions, the environmental attribute certificates, are sold from the generators. You have a couple of options. The first option is that of a bundled EAC within a PPA, and that's depicted at the top. A wind farm sells to a company both their EACs associated with their power and the electrons. That will come in at a 0 emissions factor. You have another option, which is that, and here we have shown it as the same wind farm sells some additional power, so it hasn't contracted its PPA for all its power. Some additional power it sells through to SAWEM in the purple arrow, but it splits off its environmental attribute certificates and sells these separately to the green retailer, because the green retailer is offering a higher price for them. So the purple electrons are then termed null power. They don't have any environmental attribute certificates associated with them. And the same happens in the case in this example of the SAP supplier. Finally, you have got unspecified or unclaimed energy attributes. So in this case, the fossil plant is unclaimed fossil energy, and the solar plant, one could think of the REAP currently at the moment. As we understand it, this is not confirmed what is happening to the EACs there. So these are unspecified attributes. Okay. What then happens to how does the supplier calculate an emissions factor from this null power, the purple power, because the environmental attribute certificates have been stripped away? And it's here, there is the need for what is called a grid residual mix emissions factor, which is calculated at a national level. It's not something we currently have, but this grid residual mix emission factor, GRMEF, is an adjusted factor that accounts for the retired EACs. It takes them out of the factor, generally making your grid residual mix emissions factor more carbon intensive than, or emissions intensive than that of your national greenhouse national generation grid emissions factor. So this then is the emissions factor that is applied to the null power, enabling a supplier to calculate its emissions factors that then are in the red arrows that go through to the company and the consumers. I'm now going to pass back to Brett to conclude.
Great, thank you very much, Emma.
Sorry.
Yeah, so now let's turn to sort of building on that theory that we've got as to what we've actually got in South Africa and what we're going to need moving into the future. So this is a replica of Jangi's slide, effectively, that DFFE publishes this domestic generation factor, national generation factor, the transmission losses factor, and a distribution losses factor. And really sort of a key distinction between the domestic and the national factor is where the imports are included in the calculation. We also have sort of some elements of environmental attributes schemes in operation. So in terms of the energy attribute certificates, so just as a reminder, I said that was your 1 megawatt hour of renewable electricity generated, for example. We have our own registry, so the registry being that entity that monitors the trade in these energy attribute certificates and sets up the standards and the systems for those, and that's called ZA-REX. So we've got ZA-REX operating in South Africa, and there are also projects being registered in terms of what's called the IREX scheme, or the International Renewable Energy Certificate Scheme. And this is a global scheme to track and claim consumption of renewable energy globally. So that's on the energy attribute certificate side. On the carbon offset side, well, the carbon tax makes provision for a portion of companies' tax liabilities to be offset using carbon offsets. And again, we don't want to focus too much on what that looks like. It's not the subject of today's webinar. We've got international trade in carbon offsets, and that's under the Article 6 of the Paris Agreement. And then finally, we have voluntary schemes used by companies seeking to offset emissions just for their reporting purposes. And we have one registry in South Africa, Credible Carbon, and there are various international voluntary schemes for offsetting carbon emissions, Vera and the Gold Standard. So we kind of have some of these elements in place to already start supporting the accounting of our environmental attributes in calculating electricity emission factors. And in addition, sort of looking ahead, we do have a number of the elements in place to allow us to navigate this changing space. So once again, from the policy making and tracking of policy implementation, we've got our domestic emission factor, our transmission losses factor, and distribution losses factor. And on the carbon offset side, we've got the COAS system, the Carbon Offset Administration System, which supports the carbon tax, and our own Article 6 registry. So that area, all indicated in black, is in place and needs to be continued and refined as needs as needs change. And similarly, in terms of compliance with our mandatory and voluntary reporting and target setting, we've got some of the elements in place. This national emissions factor as generation emission factor, as Jangi indicated, this is the key one used for, at present, for company reporting. But as per Emily's presentation, that requirement will change over time as we have different suppliers. And of course, the COAS and Article 6 registry are also relevant in terms of the second line of needs in this space. What we are missing is our grid residual mix emission factor. And this is something that is evolving in terms of the calculations and are still quite unclear in much of the literature as to how this is calculated. We have presented some thoughts around that in our report. And of course, then the calculation of individual supplier emission factors, which will be the responsibility of suppliers to provide. And then in terms of the carbon offsets and EACs, we are missing a credible EAC tracking system, building on what we've already got in place from ZAREX and IREC. So, and it's critical that we get these elements, particularly for accounting for EAs, into place, because there are a number of risks if we don't do this accurately and transparency, the tracking, attribution, incorporation of them into electricity emission factors. You know, I've mentioned already the concerns about double counting, and this, of course, turns quickly to greenwashing. We're concerned about market distortions and sort of diversion of investment if this is not being represented properly. There, I mentioned the CBAM, so there are considerations about export penalties and trade barriers, particularly as CBAM expands to incorporating Scope 2 emissions from more products. There's one issue which was raised during our consultation of the private sector capturing public environmental value. So this talks to a whole question about who owns the EAs of electricity being fed into the public grid. And of course, you know, coming right back to the start, we need this information for domestic climate policy making. So it's critical that we start to get these kinds of things into place and resolve issues such as who owns the public EACs, to follow on from the previous slide. And noted here, it's already been raised in the Q&A about the REAP project, so who owns those EACs. Whose responsibility is this? So both in terms of setting policy and designing and implementing legislation, how do we achieve the accurate tracking of EACs and given scarce resources within the country, and what do we prioritize for now? And then finally, how do we build a strategic view of how this environmental attribute value can be captured as part of the energy transition? So these are a couple of current issues that we need to resolve. And in future, we're going to have to move towards more granular time matching of EACs. So, you know, the current emission factors are annual emission factors, and we would, building on that, we would look at annual EAC issuance. But as needs change, we might need to move into, or we're likely to move into hourly tracking. We might need to look at emission factors of subgrids, so start looking at the provincial or municipal scale as needs and targets change, and possibly the implementation of domestic regulatory schemes around renewable energy targets at the national and the subnational level. So this is sort of looking at ahead as to where we might want to be moving with this. So I think this is my last slide, Chris, but really our report concludes with trying to think a little bit about the roles and responsibilities in this space. So we've developed a list of current and potential future requirements for governance, for who compiles the information and the data sources that will be used for all of the emissions factors that I've spoken about as part of the presentation and that Emily's spoken about, as well as the information on carbon offsets and RX, etc. And we recognize that this isn't one entity's responsibility. It's going to be it's a cross-cutting issue. So it's going to involve a range of institutions and stakeholders, you know, including the system operator, DFFE, the registries themselves, Eskom, etc. Our recommendation that we include in the report is that there is an interdepartmental government working group that looks at the overriding governance of the space, that keeps a barrier between the government interests and the different market players. So it's a government working group, but of course this working group will need to engage with the individual players in the space, with Eskom, with the NTCSA, with municipalities, with people trading in the EAC space, and industry and others. So I think it's something that's going to need to be resolved but formalized quite soon in order to enable us to get the systems into place to manage this in a coherent way. So with that, Chris, I'm going to hand back to you. Thank you.
Thank you, Brett and Emily, for a clear sort of introduction to a complex subject. And again, may I remind all attendees that the full work by Meridian Economics, their full study, can be downloaded from the Meridian Economics website. And we have shared a link on the chat facility where you can download it from the chat facility, but you can also download it, of course, from the Meridian website. So yes, it's a complex subject, And I think it will require a detailed study of the full Meridian report to get to grips with it. And this is an important takeaway, I hope and I believe, of this webinar. And it's great to have had Brett and Emily introduce us to this report, complex report that needs careful study, and you have it straight from the experts. So thank you again to Brett and Emily. And I'm now going to move on to our next presenter, and that is Sunny Mlalozi from Hulamin, who I first met a few weeks ago at a CBAM conference organized by the EU, European Union. So Sunny has more than 20 years of experience advancing sustainability across Africa's industrial value chains. At Hulamin, she works at the critical interface between business and regulation, guiding adaptation to the European Union's Carbon Border Adjustment Mechanism, CBAM. So yeah, that's where I met her, and it struck me, that their company Hulamin is doing a lot of work, to adapt to the CBAM, which is coming into place next year. And this has far-reaching impacts on producers and exporters like Hulamin. So it's great to see that they are doing a lot of work in this field. Sunny's approach is deeply collaborative. She works across the full value chain from upstream suppliers to downstream customers and international buyers to ensure that compliance requirements, carbon cost exposures, and sustainability of shared value commitments are understood, while advancing cooperation, fairness, and long-term competitiveness. Again, a pleasure to see you again, Sunny, and have you on this webinar. Over to you. If you could please share your presentation and put it into presentation mode, please.
Hello, Chris.
You're not yet in presentation mode, Sunny. There we go. That's perfect. Thank you very much. We can see your slide and we can hear you. Thanks.
Okay, excellent, and thank you very much for the opportunity. And I find that this is actually quite timelessly for South Africa to do this piece of work, as you mentioned, around our involvement in Carbon Border Adjustment Mechanism. But we also engage on a customer-to-customer basis, and for operations, sometimes the considerations in terms of how we keep those engagements going and meet customer expectations also then start to become key. So in the absence of legislation and other key policies in South Africa that sort of guide, it actually does take quite a bit of consolidation as well as assessment of different frameworks in order to ensure that the complexities that are intertwined in all these requirements are met to be able to keep a specific market and also be seen to be a credible supplier and an operation. So in my presentation, I'm going to look at how what can be considered by a business at the moment that is currently engaged in this process to operationalize the RECs as well as the Scope 2 mitigation option to meet these requirements. My presentation will follow a discussion on some of the legal and risk consideration around the operational context and what the value chain requirements may necessitate the organization to implement in order, again, to demonstrate credibility. In terms of a business strategy, we know that energy transition is a key lever there for decarbonization. So the ability to have a very, very solid energy and decarbonization process in the organization enables a number of key business drivers to be met depending on where the organization wants to focus on to stay in the game in order to remain relevant as well as comply. I've discussed these market pressures and customer considerations. And then lastly, I'm just going to demonstrate the airflow of how what could be considered in operationalizing this process. I think for business such as ourselves that are in this space, it's easy to lose or land in the space where there are gaps that were unforeseen when the business implements these solutions. So the ability of the country, such as South Africa, to have proper guideline around the state of play is again quite timely. Right. So from a legal and financial implication point of view, as specifically set aside a discussion on Scope 2 emissions because that's adequately covered by my previous counterparts. I'm just going to focus on enabling the REX environment in operation. So in South Africa, we aware it is a voluntary market. We are in the process of growing our credibility in how we claim environmental attribute for some of our products. And the RECs are very key in the energy space because that claim of 1 megawatt of electricity purchased locally can unpack or add value in our already energy carbon extensive Scope 2 emission embedded in some of our products or in our grid. As discussed, there is availability of bundled and unbundled RECs that are in the market, but how then the organization makes a decision what options to follow, then it becomes key, not only for immediate purchase, but if you're looking at a decarbonization pathway that has a medium-term trajectory into 2030 or 2035, and you're looking at also making commitments to a net zero, then it starts to become a little bit complex around which option to choose, because you can get a situation where an organization says, well, we just buy RECs, unbundled RECs indefinitely, but that option can also be unsustainable. Right? It is very, very key that the company that requires to make the claim over the REC is the company whose name is in the REC, right? So the rules around the registry are quite key for the organization to understand, and the REC space is also not necessarily part of the legal framework. So there are no tax-free allowances that can be claimed against the use of a REC. And if an organization were to select to go for an option that is an unbundled option, you also cannot claim any tariff deduction. So your purchase of a REC becomes an additional cost, which is quite key to consider when you're making an option. So as discussed by our previous counterparts, there are regions that have very solid legal frameworks around the control of renewable energy guarantees by using REC. Obviously, it's not the case in South Africa at the moment, but the markets that currently have those value chains that are regulated, then they start to not trust, or they avoid the use of unbundled RECs because there is quite a bit of a trust element that you need to demonstrate as well around the traceability of the source to provide credibility in the process. So as a energy and decarbonization enabler, so the methods are quite well defined. There is a Scope 2 market-based method. And if the organization also subscribes to a CDP or a GRI or science-based targets, kind of initiatives, they've also created the rules around how RECs can be used in offsetting or avoiding a scope 2 emissions in a market-based method. They usually support it, and the boundary of their applicability at the moment excludes the avoidance of scope 1 and scope 3 emission. And as mentioned, they're currently being used or required for enabling a transition period right now, for which is midterm. So before 2030 or 2035, there is an open market for the use of RECs, but once you start to make net zero commitments as an organization, then the market requires that there is more demonstration of renewable electricity by means of either a PPA or actual investing in a specific asset. So not all RECs are the same. Obviously, the unbundled RECs are in use at the moment, but they also have limitations, and those limitations can be prescribed by either the markets, or they can be prescribed by the sector, or they can be prescribed by the region that the customer is selling the product to, or the operation is selling the product to. So in terms of markets as well as customer requirements, at the moment, there is a push for green labeling or low carbon labeling of products, right? These are now being imposed on the value chain, and may require an operation to enter into a contractual agreement by means of a PPA, and they would be then required as well to declare the installation age. So they are not necessarily open at the moment to all the installation, because the intent of the process is really to ensure that the energy market transitions. So the older the installations, some of the customers or markets will prescribe the age of the installation, and they will also prescribe the production technology that they will want to purchase RECs under, and they will also want to know that some of those projects are guaranteeing some form of social safeguard in the region of the REC generation. The decommissioning against the customer product is also one of the requirements we've seen coming. So here it's quite key to ensure that for an organization that is implementing the use of RECs, there is a proper tracking mechanism that benefits how that REC is allocated using an LCA method, or how a product footprint for that product is actually going to be stated in the claim. And then at the same time, there also may be a need not only from a product footprint perspective, but for a claim around any renewable energy percentage for the products that is sent to the market. The operator will need to then have an energy management system which must ensure that there is matching of the energy or REC against the production for the customer as required. These requirements would then obviously need to undergo some form of external audits to validate, and also ensure that there's evidence that's allocated there's evidence around how the REC is allocated to the product. And then there's also quite strict checks around the procurement and how the reduction measures of that particular REC have actually been implemented by the organization. The allocations, which are usually subject to verification, can either be linear, where a plant can claim that a megawatts purchase in a year would generate 40% of renewable energy, or there can also be a claim against the avoided emission from the use of that REC. And this is then benchmarked against the emission factor for the country, because that is then calculated against the emission factor of the grid to come up with how much of those emissions would have been avoided by the organization. There's also another method called a non-linear method. Those are time-based. And then we also have product-based non-linear methods, where there is an organization can make a decision that the REC will only be allocated to an exported product, and can make a decision also that, especially for organizations that are producing a number of products and they have segmented niche products, you can allocate an attribution to a niche product, but then again, that process then becomes subject to a verification process. But these forms of allocations, I haven't seen them being required domestically. It's usually international customers that prescribe how these allocations should actually take place. So the evidence documentation and the claim validation, as mentioned, is done by external service providers. There would be a requirement to demonstrate either contracts, if it's bundled electricity plus REC, the timestamp transactions of the energy, the proof of the installation, especially if it's on generation, the meter readings, the production technology, as discussed, as well as evidence of how the REC has been decommissioned. And then for ESG reporting, the allocation of REC and scope 2 emission is then outlined to reflect what is location-based method reporting and also what is market-based method reporting, because you can't necessarily hide some systems. They will want you to net the energy against your grid energy, and then you just allocate an emission factor, but others do not necessarily show the market-based method, which is actually quite key to demonstrate in your ESG report. There are a number of statements that you can claim around the use of RECs, from the percentage of energy that is represented by the REC, as well as the scope 2 emissions that is associated with the avoidance or substitution of the scope 2 emission for essentially an operation or a product. Right, there's also sectoral requirements, and other regions may also impose certain requirements. These would include, as requirements for definition of what would be a low carbon product or a green product. So some sectors are starting to put rules around what does a low carbon product constitute, and the use of REC within the definition of a low carbon product, whether certified or not certified, what would then be the terms of engagement. International trade considerations, we've discussed CBAM, and the requirements for either using bundled and PPA as validation for your process. And those are seen to be much more stronger decarbonization options, as opposed to unbundled RECs in a net zero commitment environment, right? So in finality, operationalizing the RECs and decarbonization in the business, you would need to have a look at your upstream inputs into your operation to make a decision around what is appropriate for the claims that the organization wants to make against the facility or product. And there is a lot of activity when it comes to your process emission around billing, energy management systems, as mentioned, the allocation, as well as the verification requirements for the usage of the RECs, as well as translating those into specific claims that must also be validated by an external service provider. And before then, the stakeholder can make a certain claim for either use of renewable energy or decarbonization or any value that is linked to financing and readiness. There's also a few requirements that are coming through now for your upstream decarbonization. As you'll be aware, the scope 2 usually makes up more than 80% of your scope 1 and scope 2 emissions. But with the advent of some of the legal requirements in other regions of operation, especially in the value chain, the requirements to manage the supply chain have become legalized. So there is a need to ensure that there is a tracking backwards from your upstream material input to make sure they decarbonize so that it provides value for decarbonizing your own products, and the use of RECs by your value chain as well will need to be prescribed by the organization in line with obviously the market's requirement, etc. So that's my last slide. I hope that provided some context in this very, very busy space.
Thank you, Sunny, for that presentation. Hulamin is a company that exports a lot of its downstream aluminium produced products. And so carbon emissions, CBAM, renewable energy certificates, and all of these issues discussed today are critically important to a company like Hulamin. And it's really, heartening to see the efforts that off-takers, manufacturers like Hulamin, local manufacturers, energy-intensive manufacturers, are putting in and taking seriously how to reduce their carbon emissions in their reporting, for the benefit of the whole world. So thank you very much, Sunny, for that presentation. It's really interesting to see what Hulamin are actually doing in this regard. I'm now going to move on to our last presenter before we take a well-earned comfort break, and that is Jonathan Frick from Globalec Africa. John is a business development director at Globalec, where he has been leading the renewables team in securing new battery, wind, and solar projects in Southern Africa for 9 years. John leads Globalec's project origination in South Africa. He develops market strategy considering Globalec's long-term investment approach, and closely monitors policy reform and engages in sector-related advocacy for Globalec and various industry associations. John brings a holistic understanding of the full value chain with experience from early stage project development to project structuring and execution. So it's going to be interesting now to see this from a renewable energy developer point of view, not only renewable energy, but other energy technologies as well. Over to you, John. We're looking forward to hearing what you have to say.
Great. Thank you very much. So I'm certainly not an industry expert when it comes specifically to emissions factors and grid emissions factors, but I'm happy to share our view as an IPP on how the treatment of RECs and environmental attributes is playing out in both South Africa and regionally, and how it's evolved over the last few years since REAP has been active. So just very briefly, Globalec's a Pan-African IPP. We got just over 2.3 gigawatts of energy projects, either in operations or construction throughout Africa. In South Africa, we are typically known as a renewable energy IPP, but across the African continent, we do have almost 1.7 gigawatts of thermal plant, majority owned, operated by Globalec or in construction. And one thing I just want to touch on briefly is that IPPs, like many of the customers or private entities acting in this market, also have net zero targets as do Globelec. And where we hybrid energy producers, so have thermal assets as well as renewable assets, we do also look at our own emission intensity, and there's an element where environmental attributes we may want to use for internal offsets, where they are not automatically transferred or sold into the market. So I think there's a simplistic assumption that a renewables generator wants to try and value that attribute, either pass it on or sell it. But I wanted to flag that in many cases, some of the generators also want to retain those environmental attributes, place value on them, and they are not byproducts of renewable energy generation. So I'm very much going to focus on how we see the attributes treated in the market. So Globalec's got a track record of generating carbon credits from its early round CDM registered renewable projects, and projects that came later on that didn't qualify for CDM. We do register for RECs and earn out RECs. And we take a decision on whether we monetize these for the benefit of Globelec or use them for internal offsets. So we have a number of REIT projects. Our view, and we believe contractually sound view, is that those renewable energy certificates or environmental attributes generally vest with the seller under the REIT program. There is a process ongoing between the department and IPPs to look at that. So I'm not going to comment too much more on that. But our view is that contractually the rights to those environmental attributes vest with IPP in many cases, although there are slightly different contractual nuances from different REIT rounds, the earlier rounds to later rounds. It varies slightly. Many of these emissions offsets or reductions are being reported at a national level. So our view is the risk of double counting the environmental attributes is very high, generally in South Africa, and especially with the REIT assets. In the current market, I'd say most of the transactions are now happening in the private space through either bilateral contracts directly between buyers and renewable energy generators, or via aggregators or traders in this evolving space. But increasingly and almost entirely, we're seeing the environmental attributes accruing for the benefit of the buyer under current PPAs. That's certainly the case under bilateral and aggregated deals that are transacting in the market today. And that's really important for the buyers as they're looking to reduce their Scope 2 emissions. And many of the buyers are participants of CBAM at a group level, and are really focused on emissions reductions. So an important element there is that part of the sale of this renewable energy to private off-takers is that energy is trading at a discount to the Eskom, Megaflex, and WEPS rates that these customers would otherwise be purchasing directly from Eskom. And the environmental attributes are not really trading at a premium. They are part and parcel and bundled in those energy tariffs. And the attribute, although important to the buyer, is not being carved out and valued separately. And it's pretty much standard these days that attribute is required as part of the PPA to accrue for the benefit of the buyer. We also seeing the demand further increasing as reduction targets are broadening. There's some discussion around time matching of energy and production of that environmental attribute and the consumption of the energy on the other side. So we are further seeing, other than wanting the benefit of that attribute accruing to the buyer, there's also a big cost to the buyer when that energy and the associated attribute are not delivered for the benefit of that buyer in the event of a grid curtailment event or underperformance of the renewable energy asset. We're seeing in contracts that the buyers often require true-up or compensation for the undersupply of the energy, but also the attribute that would be associated with that energy, because they are highly sensitive to not having that attribute accrue to them. I think a second dynamic there is a number of the buyers are also looking at how the emissions credit is used, whether it's a carbon tax offset or whether they claim and retire the credit, the REC credit, to reduce their emissions. So, between those two potential uses or accounting of the renewable energy, there's also a dynamic or potential for double counting in how the buyer of the renewable energy treats or retires that emissions credit. We do think there will also be an increased demand for self-use of these credits, as mentioned previously. So I won't dwell too much on that. But just to state that they're certainly not considered an associated product or byproduct of the energy that we don't, or IPPs don't, place any value on. Looking forward, the introduction of the SAWEM and a traded market it has the potential to complicate matters and tracking and accounting on how those environmental attributes change hands and pass on through the market. And there's certainly the need for a tracking system or a traded market to really follow the ownership, transfer, and retirement of environmental attributes to try and prevent double counting. Just to kind of sum up what we think some of the key factors are here, is that there is a real need for a holistic mechanism to correctly account for the allocation and retirement of these attributes, where, as I said, there's no premium being earned on the sale of these attributes, but while the cost of not delivering them and transferring them to the buyer is extremely high, this implies there's a mismatch, and that the attributes are not being correctly priced in the market. So with the potential for double counting, I think the benefits of a rigorous accounting system or a traded market that runs in parallel to SAWEM, where the emissions attributes can be priced and transferred and traded in a transparent manner, will be really important to have such a mechanism in future. And I think brings me to the heart of the points that I wanted to raise here, and I'll leave it to the other colleagues on the webinar to take us through the mechanisms.
Thanks so much, John. That was really interesting. You've highlighted this. Who do these attributes belong to? The generator, the buyer, the off-taker, Eskom. If Eskom is the buyer under the REAP program, who owns these attributes? That has opened my eyes, and I'm sure it's an issue that's going to require some further thought, and is requiring and is in fact underway. So thanks for that really interesting presentation. And I see Bruce Mountain, our next presenter, is online. If you could kindly share your presentation, Bruce, while I introduce you. Really, it's good to see you again. You've been a previous presenter on one of our webinars. And Bruce is the director of the Victoria Energy Policy Centre at Victoria University in Melbourne, in Australia. After an undergraduate dissertation on time of use tariffs on South Africa's gold mining industry, his first job was in the Transmission Economics Division at Eskom, So yes, and a person well versed in the South African sector, having grown up here and worked in South Africa for some years. He has since had a 35-year career as a consultant and researcher in strategy, policy, and economics, focused on the electricity sector, and has lived and worked in the UK and Australia, undertaking projects in various countries. Bruce has a Bachelor of Science Engineering degree and a Master of Science degree in Electrical Engineering from the UCT, University of Cape Town, and professional qualifications in Electrical Engineering and Accountancy. His PhD from Victoria University focused on network regulation in Australia. So I think we're going to hear something about an Australian perspective to the subject at hand, bringing some experience in Australia to the table, which I'm sure will be highly valued. So over to you, Bruce, for your presentation.
Thank you, Chris. And greetings, everyone, from Naarm, which is the First Nations people's name for Melbourne. I pay my respects to their elders, past, present, and arising. Thank you for the opportunity to share Australian experience on emission accounting. It's quite a technically complex issue once you step into the detail, as you can hear from the previous presentations. And I can at least give you some exposure to the Australian arrangements, which have built up over time. There's been an obligation to report in a way that's similar to the one that I'm telling you for the last 12 years, although the actual detail of the arrangements that are currently used have only been in place for the past 3 years. How are emissions embedded in electricity consumption measured for liable entities in Australia? This is an obligation that exists on consumers, not on electricity producers, at least in respect of electricity account talking about now. So in principle, it's a straightforward calculation. Work out the average emission intensity of grid-supplied electricity plus self-produced electricity. So that all sounds pretty straightforward. A weighted average worked out over a period of time. You can choose your time period. But there are many complications. There's a mandatory certificate scheme for clean energy, wind and solar, built essentially since 2001. Producers and customers can voluntarily surrender or buy RECs in addition to the mandatory obligation. Under Australia's emission policy, some energy-intensive customers are partly exempt from RECs, and so that needs to be factored in the calculation. Some customers that also co-generate from emission-free electricity eligible to create RECs can self-consume that, and that too needs to be accounted for. And one jurisdiction of Oz, the ACT, which is where the national capital is, has set a much higher obligation on customers to acquit RECs than in national policy, and that too needs to be accounted for. Under the current arrangements, which have been in place for the last 3 years, Australia's greenhouse accounts allow 2 methods. A location-based method, which is applicable in most cases, or a market-based method, which is applicable if there's voluntary REC trade, if the customer is partially exempt from REC obligations, and or if they self-consume REC-eligible production. The calculation is easy conceptually, but complicated in practice. So I'm going to focus on the concept, starting with the objective. I have some slides with the formulae at the end, and if formulae is your thing, I'll put them up on the screen so that those viewing this presentation afterwards can screenshot the screen and see the detail of the formula. But let me try and convey the complexity of those formulae in words, starting with the objective. The objective is facility level calculation or sums for Scope 2 and Scope 3 electricity emission, the Scope 3 being electricity losses on the networks that take account of average electricity emission intensity of grid-supplied electricity and take account of actual emissions from self-supplied electricity adjusted for any production of clean energy that does not receive a mandatory REC. Fourthly or thirdly, takes account of the voluntary surrender of RECs. Customers can purchase RECs from someone else, and they can voluntarily surrender those. Generators can choose, if they're eligible to receive RECs, not to get the REC or not to sell the REC obligation, but to hand it back to the registry. And that too needs to be taken into account in the calculation. And any production of clean electricity that does not receive a mandatory REC that is self-consumed. So if you consume electricity that gets a subsidy through the REC system and you self-consume it, the objective of the calculation is to account for that. If this objective is achieved, the overall effect of this is to ensure no double counting of clean energy consumption by customers, and that the consequence of clean energy production is accounted for at the opportunity cost of the substitution, which would be grid-based electricity from essentially carbon sources, and/or might be hydroelectricity or clean electricity that existed before 2001 when the REC scheme was created. I think this is very similar to Emily and Brett's outline of the proposal that they intend. So what does the objective mean in practice for customers reporting Scope 2 and Scope 3 electricity? So first of all, you need to measure the average annual electricity emission intensity, which is, if you're purchasing on method 1, which is a locational method, varies by region, essentially province or state of Australia, which is then multiplied by the quantity of electricity that you purchase from the grid. And those factors are published by the Clean Energy Regulator, which is the institution in Canberra that administrates this system. It also means excluding electricity consumed that is exempt from the renewable electricity obligations, and aluminium smelters and some of the paper producers, those very electricity intensive users of power, are partially exempt from REC obligations. If applicable, exclude grid average emissions per unit of REC eligible generation that is voluntarily actually handed back to the clean energy regulator. The end users can choose to hand back the RECs. It's the grid average emissions is the value of the emission associated with that, because there's a mandatory RET which is over time introducing wind and solar. And so it's the residual emission intensity of the grid that the RECs are therefore valued at. If applicable, add back grid average emissions per unit of REC eligible power generation that is self-consumed. That is essentially solar and wind, which is self-consumed, and almost exclusively solar, which is self-consumed. There's very little cogeneration of clean energy other than from solar in Australia. So what does this accounting system achieve? If a facility buys electricity from the grid, they pay their share of the annual average emissions. If a facility has a PPA with a renewable generator, it makes no difference to their reported Scope 2 and 3 electricity emissions. So I'm assuming in that PPA, they're just buying the power. They're not choosing to buy, in addition, the RECs. And if they're just buying the power, it makes no difference to the calculation of the emissions from electricity purchases for them. If a customer self-consumes electricity from a renewable generator that earns RECs, what they actually report for their emissions are as if they self-consumed electricity which was purchased from the grid-connected fossil fuel and essentially the hydro generation operational before 2001, which is not eligible to connect RECs. And that number is also published by the Clean Energy Regulator every year. if a facility hands back RECs that are eligible to receive, that it is eligible to receive for REC eligible generation, or chooses to hand them back voluntarily, this reduces their reported emissions by an amount calculated at the average emission intensity of grid-connected fossil fuel and clean generation that is not REC eligible. So that's the essential architecture. I'll talk a little bit about the institutional arrangements and the essential nature of what is being done in Australia that would have to happen in South Africa if you were to implement a scheme which achieves the objectives that you've set out. And I do believe, as I say, Emily and Brett's outline is built on a very similar basis. So the essential attributes is you need a REC scheme that mandates the measurement of REC creation from eligible sources. So you need to measure who's creating what, and it has to be reported and measured and known what the various sources are. You have to mandate the reporting of the voluntary surrender of RECs. So if a liable a group or end user company has a emission obligation and they choose to voluntarily surrender a REC because they want to decrease their total carbon emission that they are held to, you need a mechanism to report that centrally. You need to mandate the reporting of self-consumption of eligible generation for RECs so that if a customer self-generates from wind and solar and they self-consume at least part of that production, that needs to be reported. So if they earn a REC in the consequence of that generation, that is netted out from the emissions that they are liable for. And finally, you need to mandate the calculation of the average annual emission intensity of grid-supplied electricity, and that's calculated other than from REC eligible sources. And that's the key thing to ensure that you don't double count. So if the South African state government wishes to develop arrangements that take account of grid emission impacts from the trade of clean energy, this architecture, mandatory reporting and so on, is needed. There are many ways to skin a cat, and policy will need to be adapted to the South African circumstances, but architecture that is essentially like this will be needed. I'll now just briefly hold up the slide where if you want to watch this presentation afterwards, you know we're on the internet to look for the relevant laws, the greenhouse gas accounts, which set out the calculations that I've set out and worked examples, and the clean energy regulator, which administrates the scheme and keeps track of REC creation and allocation. And then here's a couple of summary pages on the two different methods that I mentioned with worked examples that show how it varies by jurisdiction in Australia. And this is the market-based method, the more complex of the two methods, where if you voluntarily surrender RECs or self-consume REC-eligible generation or are partially not exposed to the RET obligation, this is the formulae for the calculation, whose principles I have taken you through earlier. So with that, I hand back to you, Chris.
Thank you, Bruce, for a very clear and well-articulated presentation that is going to be very useful to attendees. Some very important takeaways, information provided. And yeah, as you say, in principle, conceptually straightforward. In practice, a lot of issues and complications that have to be dealt with and considered. Thank you for that. So we're now going to move on to our last presenter for the day, and that is Dave Collins from MAC Consulting. Dave is a decarbonisation and energy advisor with a master's degree of chemical engineering. A lot of chemical engineers today. Master's degree in chemical engineering from Cambridge University, and he has 5 decades of international experience in industry and consulting. He uses deep technical expertise in supporting 30 companies in the mining, transport, cement, steel, banking, and retail sectors, specializing in sustainability, climate change, and pathways to a low-carbon economy. So as a consultant, his focus includes clean energy transitions, carbon pricing, disruptive technologies, and scenario planning. He networks extensively in South Africa's energy and mining industries, and I can attest to that. And he contributes to policy through business, government, and NGO forums as an advisor on the climate and energy transition, and he's a senior consultant at MAC Consulting. Over to you, Dave. Thanks.
Thank you, Chris. You can hear me and you can see me. Apologize up front. I'm a bit fuzzy this morning and also flashing green. Maybe because I'm Irish, I'm not sure. But look, I've been working on the grid emission factor since about 2012 with Yongi and DEA and DFFE and industry. And as we all know, it's been explained this morning, all these changes in the electricity supply industry, the advent of a lot more renewable electricity has led to 2 big issues. One is the accounting and reporting, which has been covered well in the last hour and a half. What I'd like to talk about is, to round this session off, is decarbonization plans. A few years ago, like the early 20s, everybody was going for net zero 2050. Everybody was trying to estimate what was going to be on the grid up to 2050. And there were many, many ways of doing this. There was the IRP of 2018. There was the Meridian CSIR work, and of course the NBI BUSA pathways work. And those gave a country emission factor, which was reasonably accurate for the grid at the time, because there wasn't much renewable energy coming on. Imports and exports were quite low. So it was a reasonably accurate indication, and a lot of people did use these kinds of sources for their decarbonization plans. But now that is now becoming a problem, which I'd like to take you through to explain. There is just one example of that's the one of the NBI pathways, going down to almost zero by about 2043. If you could just follow this with me, the structure a couple of years ago was pretty simple. We had imports and Eskom generation and Eskom feeding the grid. We had very low volumes of IPPs and low volumes of on generation. So consumers were basically relying very largely on the grid electricity. That's the way it was. And this is all now, of course, changed, as we know. First of all, a market operator is being established. Secondly, IPPs coming in much, much higher volumes, and companies doing a lot of on generation, particularly the mines, for example. But the other interesting one that's now come up is Eskom. And we can consider the possibility of Eskom splitting into 2 streams. And let's just explain what that means. Eskom has made it very clear in the marketplace that they want to get into, well, this is a report from Bloomberg saying they want to be in direct competition with IPPs. They want to get into solar. They also want to get into nuclear. I see that was referred to in the chat this morning, in the sense that, A, they would generate nuclear. And of course, there's the other complication that Eskom's considering trying to sell Coburg nuclear attributes separately. And it's all based on this chart, which has been around, I think, since about September 24, when I certainly first saw it, showing what Eskom aspires to do by 2040 was 32 gigs of renewables, 10 gigs of nuclear, and then the coal winding down and some gas. Now, if you make some reasonable assumptions on the availability factors, etc., and the emissions, you end up with this very interesting chart. And if you just focus on the middle one for a second, the middle line, if Eskom was able to do what that vision says, and I know there's a wide range of opinion as to whether and how that might happen, we're aware of that, but if they were able to do that, a combined scenario would end up with a grid emission factor of around 0.3 in 2040. If, however, they managed, as they have said they'd like to sell all the clean component, or at least as much as they could, separately to industry, that clean component obviously has an approximate grid emission factor of 0, but it means that the residual, which is fossil now, would be 0.7. So the implication of that is, and this is just a scenario, it assumes that Eskom's generation vision is achieved, and it assumes that they can sell all the clean electricity separately. But look at the impact that would then have on what goes to the market operator, which is essentially the fossil component. A consumer can have 4 sources of supply. Now, I should have said earlier, I'm ignoring all the complications of distribution and municipalities. I know this doesn't reflect the commercial structure, but it's really the accounting structure. So a consumer could end up with 4 sources of supply. Own generation, in which the emission factor is known, number 1. Number 2, from IPPs, in which the emission factor is known. 3, from the grid, from the market operator, and that emission factor is not known, is not quantified, and we'll come to that in a moment. And then, of course, if they buy from Eskom, clean supply from Eskom, again, the emission factor is quantified. So the question then is, how can we estimate what is on the grid? And that is the purpose of this whole short discussion that we're having now. How can we estimate what is going to be on the grid available to the general consumer? So the grid can have 3 sources of supply. The market operator can be fed by IPPs, imports less exports, and then what Eskom has left, the residual supply to the grid. But how can we determine the future emission factor with these 3 sources of supply? IPPs, there's a huge dependency there, the rate at which IPPs will be able to finance and build new capacity. The middle one, government policy, effectively will determine imports, less exports, and it's not a major factor, at least not at this stage. It's not showing any signs of being a big amount. And then the third one is the rate at which Eskom will be able to build and finance new capacity and their success in selling cleaner clean or cleaner electricity separately. And the top one, the IPPs and Eskom, are going to be in competition. There's going to be a tension. So I've got to the point of realizing that there are so many moving parts in this whole situation. There are so many variables. It is not possible at this stage to quantify, obviously not even a single straight line. It's not going to be like that. There's going to be a range of scenarios depending on the assumptions made. And I've been talking to quite a few people who I know are on this call. And what I'm suggesting now to go move forward, if anybody else would like to join a small group to investigate this, we need to look at all the, as I said, the moving parts, the variables, the assumptions that we have to make. And we'll end up with a range of scenarios of what's going to be on the grid. No quantitative number at this point. So please do contact me and let's aim to get this done in the next couple of months. I'm going to suggest to the NBI and to BUSA that we can regard this as an extension of the 2050s pathways work that was completed 3 or 4 years ago, but that has not been resolved yet. And back to you, Chris. Thank you.
Yeah, thank you, Dave, for those deep thoughts. And it's a very important matter you raise. and also thanks for your offer to the audience to be in touch with you, to do further work on this subject. And yeah, I'd like to say that if, with your permission, Dave, I would include your contact details in the report back that goes to all the attendees today, so that they are able to contact you. Obviously, I'll only do that with your permission, but you've invited people to contact you, so I assume you want to give them your contact details. Thank you. I will take that as a yes. Ladies and gentlemen, we're kind of spot on time at the moment. It's 12 o'clock and we've got half an hour to do a Q&A. And I just want to thank our presenters who have really done a fantastic job in helping me with the Q&A, because there are 47 questions that have been posed and have been already answered on the text Q&A facility. And there are 3 open questions at the moment. Oh, I see now only 2 open questions. So our presenters have really done a sterling job in engaging with attendees and answering the many and valuable questions that have been raised. And really that is great, because it shows that we are really taking this seriously and trying to answer the questions. And to be frank, I can't answer them. It's these experts that we have around the table that answer them. I'd like to ask all the presenters now if they want to switch on their cameras and their microphones, because we're going to do a bit of a Q&A. And I'm going to actually, I mean, I've seen so many questions and many of them have been answered on the text facility, but I think it's worth posing this question again. And Emily has kindly offered to deal with this question because she has spotted it. She says there's a lot of questions around double counting of renewable energy certificates and carbon offsets, and this is an important subject, often confused, and that she said she was very happy to answer some of these questions live here on this panel discussion. Yeah, so can I ask you, Emily, to come in at this point? I don't see, there, I see you there now. If you could come in and give your thoughts on this whole question. You've seen many of the questions on double counting, and you said you'd like to come in here with some answers, so please feel free.
Thanks very much, Chris. So specifically talking to the issue of double counting between carbon offsets and EACs, if you recall the diagram that we put up of environmental attributes, there were 2 separate paths for EACs and carbon offsets. And Brett spoke to that diagram to say that the 2 are different animals, carbon offsets and EACs. They are specified differently through different standards. But the problem, or the issue, is that they could both potentially lay claim to the same underlying environmental attributes. In consideration of all the credible standards that we have had a look at in both the EAC world, so that's the REX, the IREX, ZAREX contracting, and then in the carbon offset world, the gold standard, the CDM, there is always a statement in those contracts that you cannot double count the emission reductions through another instrument. So this is the sole claim to the emission reduction. So in a sense, those standards take care of this issue. And this is what led us to the point that the offsets used in the carbon tax, together with offsets used in ITMOs or offsets used even in the voluntary for sale in the voluntary markets, will not by definition double count with REX, because in their contracting they cannot, in the development of that offset they cannot. So I think that's just important to understand, because it does help separate out those 2. One doesn't need to build in special mechanisms to ensure that this doesn't happen, because if it is an offset or an EAC is developed according to a credible standard, then it cannot by definition double count. And it might also be worth, I think John spoke to it quite briefly, but the potential for developing carbon offsets via renewable energy projects in South Africa is very, very slim now. All the credible standards, again, are not allowing this. There is a dispensation in the carbon tax to allow it for a certain period of time. So that is just reflecting that renewable energy generation is commercially competitive. And so there's no additionality, which is critical in the carbon offset world to create a carbon offset. So there's that issue as well, that the carbon offsets will become less and less of an issue apart from those focused on the carbon tax. But we don't need to worry about that. Those standards, as far as we have noted, are well established, and there is this the clause around the double counting. So the focus needs to be on the EAC side, where there's very little and development in terms of registries and tracking. And well, there are registries, but making sure that the reporting and everything it accounts for all of these adequately. Thanks.
Yeah, thanks, really, Emily. I think that gives some reassurance, but also some indication that there are still some work to be done. I don't know whether any of our other panelists want to, come in on this. If they do, please just switch on your mic and say so. But before I go to you, panelists, and I see Sunny's hand is up, so I'll come to you just now, Sunny. I just want to say that we've kind of answered all the Q&A questions, the text questions. So that's really nice, and gives us the opportunity for anybody who wants to put up their hand, any of the attendees who want to put up their hand, please do so. And I come to you, and you can pose your question verbally. I will switch on your microphone when I come to you, and then you can pose your question to the audience. And I see there's a hand already raised. Thank you, Etienne. And I'm sure there will be others. But Sunny, you had your hand up, and I think you wanted to come in on something that Emily had said. Please do come in at this point.
Yeah, so I just wanted, in extension, to say the claimants are more likely to be the culprits that probably overstates the claims or double use the claims. So it is important for any claim to have undergone third-party verification, just to limit that greenwashing issue that comes with, overextending your greenness using specific claims. So that's the risk that still exists.
Thank you, Sunny. If there's anyone else wants to come in, and please, audience, please, attendees, put up your hands if you want to ask a text question. Otherwise, ask a verbal question. Otherwise, we assume that all your questions have been handled, to date. So let's move to Etienne Rubbers, who has raised his hand. Etienne, I'm going to allow you to talk now, so please switch on your microphone and ask your question, please.
Thanks, Chris, and thank you very much for the webinar. It's a question I had in the chat, in that we have the IRP 2025, which is going to emit more CO2, and it's not consistent with our NDCs. And my question is, when they put together the IRP 2025, was the DFFE consulted to make sure that it's within the limits of the NDCs? And the second question is, do we need to revise our NDC targets given the new IRP? Thanks.
Thank you very much for that question. Yeah, the IRP was published yesterday, so it's really hot off the press, and I'm sure a lot of people are busy studying it as we speak, including you, Etienne, and me too. I don't see Yongi online at the moment, which is a pity, because your question is kind of addressed to him. I do see Yongi there. Yes, Yongi. Thank you for coming in, and perhaps you can deal with Etienne's question to the best of your ability.
Yeah, thank you, Chris, and thanks to Etienne for raising that question. So the answer to the first question is yes, we were consulted in the development of the IRP, and especially the revision for 2025, which is what you see now that has been published. And we then impose a constraint, a CO2 constraint. So in terms of answering the second question, our assessment shows that we will meet the NDC target, taking into account the CO2 constraint that is actually documented in the IRP 2025. That alone wouldn't have helped us to meet our 2030 and 2035 target. But if you couple that with, if you look carefully at the NDC document, both for the 2030 and for the 2035 time stamps, it talks about accounting for natural disturbances. In other words, we have to isolate the impact of natural fires and to a lesser extent impact of wind on trees. So if you account for that natural disturbance phenomenon accounts for about 40 million tons to our total emissions. So if you discount that, you consider also the CO2 constraint, it helps us to keep within our targets, even though that we are more on the upper end of that target range. So that is the answer to that question. Thank you.
Thanks, Yangi.
Yeah, thank you so much for that answer. It's great to have you available to give a clear, straightforward answer. I don't know if anybody else on the panel wants to come in on this particular issue before I move on to the next hands up. Okay, so we haven't had any other contribution. Did I see you saying something, Jongi?
No, Chris. I was just saying, it's fine. It's answered. Yes.
Thank you. So, okay, I see another hands up here, and I hope I'm pronouncing this right. Khadija Musa. Khadija, I've allowed you to talk. Please switch on your microphone and pose your question. Thank you.
Very much, Chris. I just had a follow-up question for Bruce, and thank you for answering the initial one. This was in relation to when a generator hands back a REC to the registry, where Bruce then said basically that generator is giving up the potential income from selling that REC. And the answer was that the registry simply adds up those numbers, and then they now know, the facility or the registry now knows how much emissions they've benefited, and they just add that to the calculation of the emissions. My follow-up though was, I'm trying to figure out, okay, now once the facility adds up these emissions, what do they then do with them? Like the way, for example, because I'm assuming here the registry is owned by the authorities, the government. If it was carbon, for example, it could be that instead of the private carbon credit person selling it on a voluntary carbon market, if it was for the country, it could be sold as an ITMO, for example. So is there an equivalent for that for X, or what are they doing with these additional calculated emissions that they've gotten when, let's say, someone voluntarily hands up their X? Is it towards a policy? Is there an equivalent for like ITMOs in the REC mechanism? I just want to know where it goes beyond.
Okay. Thank you. So I think this could perhaps best be handled by Bruce. It was a point addressed to him, and also maybe by Brett. So let's firstly see if Bruce wants to come in and say anything.
Yes, I can, Chris. So just briefly, the Australian government has a national emission reduction and clean energy policy, which establishes a REC obligation, which all customers need to acquit through a mandatory obligation. So RECs are created pursuant to that obligation. A customer that co-generates from a solar facility can get a subsidy under that scheme if the solar generator was REC eligible, which it's bound to be if it's of a suitable size and so on. If they then don't get the REC value associated with the RECs created from that solar facility and instead choose to hand it back to the registry, they are foregoing the income associated with that REC. They're handing it back to the registry. The registry notes it as a credit that has been registered. And what the customer who owns the cogeneration facility gets to do then is establish an emission total for their facility, which is reduced by the voluntarily surrendered RECs. As a consequence of that, if there was a national emission policy which priced emissions, they could reduce the emission liability that they face. In practice, we don't have a national emission obligation in Australia. We do have a somewhat parallel policy that establishes a shadow price on emissions. So there can be a commercial value for the customer as a consequence of voluntarily handing back its wreck. But the wreck registry doesn't get to do anything, doesn't get to trade with it commercially. Its obligation is to recognize that it was handed back and to ensure that the emissions difference as a consequence of that are taken into account in the calculation of the residual emissions, which implicitly they are, because it measures the electricity generation from coal and gas mainly. I'm not sure if that quite answers your policy. The essence of the voluntary surrender is essentially customers get to buy greener association with the things that they produce as a consequence of choosing not to get the REC subsidy.
Thanks, Bruce. Brett, do you want to come in here at all?
Thanks, Chris, and thanks. Sorry about that feedback. So yeah, I think it's going to operate somewhat differently in South Africa, where there are no mandatory obligations at the moment to surrender RECs. So I think what is done with the REC does depend on the purpose of why a customer is buying RECs. So you know, if it's a voluntary action in order to report against that green electricity has been procured to offset the grid electricity, buying a REC separate from the power, it will attract a certain value. I think the important thing is, once again, to follow up on what Emily said, is just to make sure that those RECs aren't used in multiple situations. So they've either, you know, if it's going to be used as used for voluntary claims against the purchase of renewable electricity, then that REC needs to be kind of written off. So we call it retired and not used for any other purposes. I think so that's one side of the story, is where is that REC used? But then to follow up, I guess, on what Bruce has said, is that the retirement of those RECs is also taken into account when considering the supply emission factors that are calculated for individual consumers. So if RECs have been retired for a certain purpose, such as voluntary reporting, then they cannot. Then there's the adjustment for them that's made when calculating a supply emission factor. So that's the whole case of null power and grid residual mix emission factors. So I think it's just important to be consistent across the board as to how they are accounted for, and then value will be determined by the use.
Thank you for that, Brett. And I see here hands up from Michelle Rivarola. Michelle, I've allowed you to speak. Please switch on your microphone.
Sorry, I just raised the usual concern that the aim is to actually reduce carbon emissions. It's not really to offset them. Now, RECs don't really do much in that respect. All they do is like somebody being told to say 5 Hail Marys and 2 Our Fathers and all your sins are forgiven, and pay your tithes, and off you go, carry on. And I mean, it's a fact. Unfortunately, I attended the last board meeting of Shell remotely in Holland, and it was shown that their carbon footprint was increasing by 4% per annum compounded, whereas they were claiming that it was being reduced because of the ability to buy credits around the world. So are we really achieving what we're setting out to achieve? And I mean, Chris, I think you pointed out the IRP 25 failures. Gas is probably one of the biggest ones, because while it's clean when you burn it, it's certainly not clean when you start drilling for it and you start conveying it in leaky pipelines. So, you know, all these things are going to play into eventually, if you're a manufacturer and you're trying to export and you have scope 1, 2, and 3 emissions to account for, the scope 3 are going to kill you. And RECs do absolutely nothing.
Let's put this question, I think, to Dave, to say, you know, is there really a purpose in all of these RECs? Michelle has sort of questioned the whole business of trading. Would you come in, Dave, and give your view on this?
Well, RECs is a necessity in order to track all the flow. It's an accounting necessity. I don't see how you are actually fiddling the books or doing your Hail Marys, as you suggest, Michelle. I don't see how this is a necessary mechanism to track what's going on. It's not a way of in any way fiddling one's emissions or being creative in accounting, or it's not like carbon credits. It's quite a separate issue. And maybe Emily, I think you had your hand up a second ago. Would you like to comment?
Thank you, Dave. Yeah, a comment that I think refers also to the previous question that, and whilst Michelle, you're completely correct that this is a tracking, and the tracking and the trading mechanism doesn't in and of itself reduce emissions. But I think one point we make in the report, and Brett spoke to, was that the mechanism of certainly compliance schemes for RECs, and even if one doesn't have compliance schemes for RECs, if there is a market demand for RECs, the implications for the South African electricity system are, as soon as value is starting to be attributed to them. I'm hearing that John said it's not yet, but assuming that comes, the implications of the South African electricity system are quite significant, we think, in terms of potentially driving custom away from the public suppliers of electricity. So it's beyond an accounting issue in terms of this is a mechanism that can be harnessed to support our energy transition to be more just, and to happen in a less haphazard manner. As there is a greater demand and imposed by CBAMs and potentially other mechanisms for a demonstration that companies are actually purchasing and using renewable electricity. So it's complex, but a thought has to be given to it beyond just the accounting mechanisms that we've largely been discussing here, because the unintended consequences of what the private market might just do anyway, as there starts to be a greater demand for the renewable the components of electricity, is quite profound. And it's in the public interest to get on top of this issue and to understand these potential unintended consequences, and then to design schemes and mechanisms. And, for example, what happens to the nuclear and the renewable, the REAP environmental attributes, to do this with clarity of a vision for where the electricity sector is wanting to go, and in terms of the greenness of it. So yeah, in response to both those last two questions. Thank you, Chris.
Yeah, thank you very much, Emily. I want to now move to Sandiso Lubisi. I'm allowing you to talk. Please switch on your microphone for this.
Good afternoon. It's afternoon already. Good afternoon, everyone. Thanks, Chris, and thanks to your panel there for their presentations individually. I think what I want to ask is, and I'm not sure, and excuse me if maybe this has been touched on earlier, certainly by any one of the presenters earlier. I want to check, how does this tie into the current regulatory requirements in South Africa around the landscape in terms of the greenhouse gas reporting for companies? Currently in South Africa, we've got the SAGA system, which is partly also enforced by obviously the greenhouse gas regulations and the guidelines, but also you would find this in most of any emitters' atmospheric emissions licenses as a requirement that it needs to be done. I want to check with you guys, how does this tie into that specifically, or is it looked at as something that's going to tie into it in the future? And do we see this becoming a regulatory requirement in some shape or form? That's my first question. The second one is, seeing that this has some monetary value, sort of, you could say, opportunities in terms of an entity selling the certificates that you have mentioned through the system that's managing this and tracking this. What would actually push, first of all, how does it intertwine with carbon offsetting, which is fairly similar to it, although it might be different because this is mostly on the greenhouse gas requirements or reporting, you could say, attributes. But what would actually say someone would sort of maybe trigger both? You are talking about greenwashing and also double reporting by any entity. And for an entity that's already, started on carbon offsetting activities and also contributing to that, and maybe, claiming those also through the COA system already. What opportunities do they have with this coming into play in terms of them tapping into it, but also at the same time avoiding double reporting and double claiming between the two? And what would actually push them to do one or the other or both in that sense? Just maybe some clarity on that for me. Thanks, Chris.
Thank you. And yeah, Jongi, I think maybe you're the best person to handle the first part of the question on the regulatory aspect. And then we'll perhaps go to John because he hasn't had a chance to speak, and also to Sunny. I know she has spoken, but I think I'd like to give you the opportunity also to come in. So, Jongi, over to you on the regulatory aspect.
Thanks, Chris and Cindy. So, yeah, in fact, on the reporting program, we do have a reporting program in place that is quite comprehensive, by the way. I did talk to that in my presentation. So if you look at this through the lens of the GEF, you saw the equation that the numerator has emissions in there. So most of that is covered. So if you're an operator and you generate emissions in the power sector, we will have your emissions information. But when it comes to, the electrons and the tracking the attributes, currently there's no legislation that's dealing with that. Interestingly, at the time when the legislation was being developed to marketize the power sector, we participated in those engagements that were led by DE, and we pleaded to say this aspect should be considered. But I suspect there were other pressures they had to deal with at that time. So, but in the future, this should be addressed. Thank you.
Thanks, Jongi. And can you come in, John, if you want to say anything about the value of RECs and how one sets a value to them? The question was a little bit beyond me, I'm afraid, but I hope you got the gist of it. Are you there, John? Okay, look, maybe John has had to drop off. No problem. Sunny, do you want to say anything on this issue?
Yeah, so I just want to highlight that it is quite complex, and especially for organizations with an extensive value chain, because, for instance, the tracking of carbon, organizations such as ourselves, we have 4 different calculators because there's different nuances for the different calculations that you have to bring into consideration. And by the way, all 4 of them are validated differently and separately and by different parties. So the credibility also lies within organizations to understand where the value is, where the organization is spending OPEX and CAPEX to transition to a better world, as well as where it can actually advance or maintain the market or just those benefits. It's not necessarily a case of just slapping reporting. It's underpinned by what is the value system for the organization, and then you create system that gives the organization the credibility to report across different platforms and be able to be tracked and audited and be found to be credible as well.
Thank you, Sunny. Ladies and gentlemen, unfortunately, we have come to the end of this webinar. I do see there's 2 or 3 questions still unanswered, but we've dealt with 52 questions in the text form and about 10 questions on the verbal Q&A. It's 12:30 now, and I know that people have a very busy program, and I'm very reluctant just to carry on in that respect. So I know there's 1 or 2 questions unanswered. I apologize for that, but you will get some contact details of the presenters with their permission in the feedback report, and you're welcome to make contact with them in this regard. So thank you very much to our audience. It's been great to have you. You are what it's all about. I thank you to our very esteemed presenters who've done an excellent job today. That's Jongi Witi, Emily Tyler, Brett Cohen, Sunny Mandaloza, Jonathan Frick, and Professor Bruce Mountain, and last but not least, Dave Collins from Mac Consulting. It's been an absolute pleasure having you here. I think it's been productive, and I just want to thank the following organizations for allowing people to come on here, spend their time, and communicate with us, people of South Africa and further afield. And that is, in particular, the Department of Forestry, Fisheries and Environment, Meridian Economics, Hulamin, Globalec, the Victoria Energy Policy Center, and Mac Consulting. I just want to acknowledge the invaluable help that I have had from Dave Collins and from Emily Tyler in particular in setting this up and looking at getting the best presenters on board and sorting out, helping me with the content. It's been great to work with you, and your role is highly appreciated and hereby acknowledged. So, ladies and gentlemen, watch out for our next webinar on Friday at 11 o'clock in the morning on a fascinating new topic that I want to learn a lot more about, and that is how to operate coal-fired power plants flexibly. It's going to be an interesting one, a controversial one, of course, as usual. These things are not easy. But it's going to be a great webinar, and we hope to see you on Friday at 11 o'clock. Please register to attend. So with that, thank you again, and over and out from me.